The quiet kings of finance. How rating agencies secretly shape the global economy. Power in finance does not always roar. Sometimes it whispers. Sometimes it hides behind neutrality, objectivity, and technical language. And sometimes it sits quietly in office buildings, far from trading floors and political chambers, shaping the destiny of countries without ever appearing in the headlines. These are the rating agencies, the quiet kings of modern finance. They do not trade, lend, or invest, and yet their opinions can move markets, destabilize governments, and alter the future of entire nations with a single decision. The world of credit ratings feels distant to most people. It seems technical, dry, irrelevant. But behind those letters, AAA, AA, BBB, and the dreaded junk status, lies a power that touches every part of the global economy. Those letters determine how expensive it is for countries to borrow, how much interest companies must pay, how safe investors feel, and how confident markets remain. In a financial system built on trust, ratings are the public verdict on who can be trusted, how much, and at what price. In the city of London, traders follow these ratings closely, but most citizens barely notice them. They don't see how a downgrade in a distant country raises the cost of goods in their own supermarket. They don't feel how a change in ratings shifts pension fund strategies. They never realize that the global financial weather can be altered by a committee meeting inside a quiet office. The agencies do not shout. They simply decide and the world reacts. To understand their influence, imagine a country facing rising debt. Its economy is slowing. Its political situation becomes uncertain. Investors begin to worry. Then one of the major rating agencies, Moody's, S&P, or Fitch, downgrades its debt by a single notch. Instantly, global funds must sell its bonds because their rules prohibit holding lower-rated assets. Interest rates spike as the government is forced to offer more compensation for risk. The national currency weakens. Inflation rises. Public services struggle. The downgrade, which took minutes to announce, now affects millions of lives. This is not theory. It is reality. It has happened in Europe, in Latin America, in Asia, and in Africa. A brief change in rating has thrown entire economies into crisis. And yet, the rating agencies are not elected. They are not directly accountable. Their models are not public. Their decision-making is partly subjective, but their influence is absolute. Their power grew during the expansion of global debt markets. As countries and companies borrowed more, investors needed a way to compare risk quickly. The agencies filled that vacuum. They became the translators of financial health, the interpreters of whether a borrower was reliable. Their ratings became mandatory. Governments depended on them. Corporations feared them. Banks structured their portfolios around them. The agencies were no longer observers. They were participants. But the world discovered the darker side of their influence during the 2008 financial crisis. Complex financial products that were filled with hidden risks, mortgages destined to fail, loans built on unstable assumptions, somehow received the highest possible ratings. AAA, safe, virtually risk-free. Investors trusted those ratings. Pension funds bought those products. Banks used them as collateral. When the truth emerged, the system collapsed. The ratings had been catastrophically wrong. The agencies had certified dangerous safety. The fallout was enormous. Regulators accused the agencies of negligence. Politicians demanded reform. Investors demanded accountability. And for a moment, it seemed that the quiet kings of finance would lose their thrones. But they didn't. The system could not function without them. And so, despite the scandal, the agencies continued, chased and criticized, but still essential. Today, their influence is deeper and more global than ever. A sovereign downgrade can shift trillions of dollars. A negative outlook can weaken a currency. A rating watch can trigger political pressure inside parliaments. Behind every market, behind every bond auction, behind every investment decision, the agencies stand as gatekeepers of trust. They shape the financial reputation of nations with a pen stroke. Inside their offices, analysts study economic data, political developments, fiscal policies, and global trends. They debate quietly, forecast carefully, and publish ratings that ripple through financial markets within seconds. Their language is technical, measured, and discreet, but the consequences are anything but quiet. Funds liquidate positions. Traders react instantly. Governments may find themselves forced to raise taxes, cut spending, or negotiate bailouts because an agency declared their finances unstable. The City of London relies on these ratings. Banks use them to determine collateral requirements. Hedge funds use them to price risk. Insurance firms use them to structure portfolios. Pension funds use them to protect retirees' savings. Without ratings, the global financial system would lose one of its key reference points, a shared measure of stability. And yet, the dependence comes with danger. Ratings concentrate enormous power in organizations that are not democratically accountable. Their judgments, even when well-intentioned, can become self-fulfilling. A downgrade can worsen the situation it describes. A warning can cause the panic it tries to prevent. A negative report can trigger the very crisis it sought to measure. As the world becomes more unstable, the agency's influence will only grow. Climate risk, geopolitical conflict, demographic change, technological disruption. All these forces will strain nations' finances and increase the need for trusted assessments. The agencies will be asked to judge countries navigating energy transitions, rising sea levels, political instability, and technological uncertainty. Their ratings will determine which nations thrive and which struggle to secure investment. The future of the financial system may rest partly in their hands. If their judgments remain sound, they will help stabilize global markets in times of turbulence. But if they misjudge, miscalculate, or succumb to political pressure, the consequences could be catastrophic. The next crisis may be sparked not by a bank failure or a market bubble, but by a misaligned rating that sets off a chain reaction in a fragile world. Inside the city, where markets breathe the same air as these ratings, the awareness is constant. Traders watch every announcement. Governments prepare statements before decisions are made. The agencies move quietly, but everyone listens. Their influence is a reminder that global finance is not just numbers, it is perception. And perception, once changed, becomes reality. The quiet kings of finance will never dominate headlines. They will never appear on magazine covers or on trading screens. But their decisions shape the world more than most politicians ever will. They are the custodians of confidence, the interpreters of risk, the unseen arbiters of trust in an uncertain age. In the next episode of Cinematic London Finance Chronicles, we explore the final layer of global financial influence, the network of international institutions, secret negotiations, and global standard setters who quietly shape the rules of the world economy. Subscribe and continue the journey into the forces shaping our world.